Friends, let's talk about cost of funds. It's a term that might sound a bit dry, but trust me, it's more interesting than it seems. Don't worry, I'll keep it brief. We all have busy lives, right? Mostly because I don't fully understand it. Just kidding, sort of. But seriously, it's not as complicated as it sounds. Cost of funds is basically the price banks pay to get their hands on that sweet, sweet cash they lend you. It's like the interest rate they pay to borrow money. Think of it like this. Banks are like middlemen in fancy suits. They need to get money from somewhere before they can lend it to you. They borrow money from one place at a cost and lend it to you at a higher cost because capitalism. Why should you care about this? Well, the cost of funds affects the interest rates on loans and mortgages. If banks can borrow money cheaply, they can offer you lower interest rates. Well, the cheaper it is for banks to borrow money, the cheaper it is for you to borrow from them, unless they're feeling greedy. And let's be honest. Let's be honest, they usually are. So next time you hear about interest rates or loan terms, remember it all ties back to the cost of funds. Understanding this can help you make better financial decisions and maybe even save some money in the long run. Imagine banks strolling through a financial supermarket. They've got their shopping list, need more money, where do they get it? Option 1, deposits from regular folks like you and me. Banks are like, we'll give you a tiny bit of interest for your trouble. It's like the discount bin of banking. Option 2, borrowing from other banks, or even the big daddy of them all, the Federal Reserve. More on those guys later. Option 3, issuing bonds. It's like taking out a loan from the public. Risky business, but hey, sometimes you gotta do what you gotta do for more cash. Remember the Federal Reserve? You know, the big, imposing building with all the power over our money? They're like the cool kids in the financial playground, always making the important decisions. They set this thing called the federal funds rate, which is basically the interest rate banks charge each other for overnight loans. It's a big deal. It's like the hottest gossip in the banking world. Everyone's talking about it, analyzing it, and speculating on what the Fed will do next. When the Fed raises rates, banks get nervous, borrowing gets more expensive, and the whole financial world feels the tension. And guess who they take it out on? That's right, you! Suddenly, your loans and credit cards have higher interest rates. Higher interest rates on loans, here we come. Your monthly payments go up and it feels like you're paying more for everything. But when the Fed lowers rates, it's party time. Banks can borrow money more cheaply, and the financial mood lightens up. Banks can borrow on the cheap and might even pass on some savings to you. Maybe. Don't get too excited, but there's a chance your loan rates could drop. Lower rates can stimulate spending and investment, making the economy more vibrant. So keep an eye on the Fed. They're always in the house, making moves that affect us all. Part 4. So, how do banks figure out this cost thing? Banks aren't exactly known for their simplicity. They love a good formula. To calculate their cost of funds, they take all those different sources of money, deposits, loans, bonds, and average out the interest rates they're paying. It's like a financial smoothie, blending all those costs together. Delicious, right? The lower their cost of funds, the happier banks are. It means they can lend money at higher rates and make a tidy profit. And by tidy, I mean obscenely large. Part 5. Cost of funds versus cost of capital, because confusing you is fun. Now here's where it gets really fun. Cost of funds sounds a lot like cost of capital, but they're not quite the same thing. Think of it like this. Cost of funds is like the price of ingredients for a cake. Cost of capital is the price of everything involved in making that cake. Ingredients, oven, that weird apron your grandma gave you. In other words, cost of capital includes all the money a company needs to operate, not just the money it borrows. Clear as mud? Perfect. Part 6. In conclusion, knowledge is power, but money talks. So there you have it, the cost of funds. We've journeyed through the intricate maze of financial terms and banking jargon, a thrilling ride through the world of banking jargon. It's been a roller coaster of understanding, with its ups and downs, twists and turns. Why did we do this? Why dive into such a complex topic? Because understanding this stuff, even a little bit, can help you make better financial decisions. It empowers you to take control of your financial future. It's like knowing the house always wins in Vegas, but you still show up with a wad of cash and a dream. You know the risks, but you're prepared. The more you know about how banks work, the better equipped you are to navigate their system. Knowledge gives you the tools to make informed choices. And maybe, just maybe, you can come out on top. With the right knowledge, you can turn the odds in your favor, or at least slightly less broke. Good luck out there. Remember, every bit of knowledge counts. Stay informed, stay empowered.